Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, the conflict in Iran and Strait of Hormuz blockades snarling supply chains. But it goes beyond just oil and gas. What it could mean for the everyday items you buy and how investors should position themselves. We begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Josh Schafer, Teresa Rivas, and Jack Howe. So Josh, last week we talked about how the stock market was being totally controlled by oil. That has changed, but I'm not sure it's for the better.
No, it has not, Jack. So oil's still driving the market to some extent, right? I mean, it's not like oil went lower in the prior week, but oil being elevated and the impacts of that, I think, is what the market is sort of dealing with right now. And this conflict really not going away, right? And so what you saw is the S&P 500 down again, NASDAQ down again. NASDAQ actually almost entered a correction, almost down 10% from a local high on Friday. What's weighing on that, Jack, is we got more bad news, right? So on Wednesday, you had a hotter than expected wholesale inflation reading. Then a couple hours later, you have Federal Reserve Chair Jerome Powell come out. He says, you know, that reading, it's not that good. We're probably not cutting rates anytime soon. And so that really drove the market action. That was when you saw a lot of the moves to the downside that carried through on Thursday and Friday, and a lot of moves in the bond market this week, Jack, catching my eye.
Yeah, PPI, 3.4% is kind of ugly. So talk to me about the bond market. 10-year spiked in terms of yield, price went down.
The 10-year hit 4.4%, Jack. And so it's up over 40 basis points since this conflict started 3 weeks ago. And one thing that I always like to point out is when you look at the course of this bull market, so going back to 2023, really, whenever you've seen more than, I would say, a 10 basis point increase, which is essentially what we saw this week in the 10-year in a given week, and it's above 4.25, right? We're increasing on inflation expectations here. That's been a headwind for stocks. So we're in that environment right now where higher rates is not good for stocks, and that's something that's really starting to stick with investors, I think.
Yeah, there's a theory that while the stock cowboys do whatever they want to do, you got to worry when the bond investors get concerned that the bond market is smarter than the stock market. Another sign that was not very comforting was that good news was bad news. Good earnings weren't saving a stock this week.
Yeah, so you take a look at Micron this week, right? Micron, very impressive earnings. Of course, we should caveat this. The stock was up 300% over the past year going into the print, so sometimes you see stocks sort of sell off. But one thing, when I was speaking to investors earlier in the week, and they're saying, you know, we'd maybe position in tech here, maybe there's some opportunity in tech off the bottom. The question is, where's the bottom, right? And you're going to need sentiment to sort of come back. And I think Micron earnings sort of show you that we're not quite ready yet for risk on sentiment in terms of this market. I think you need to see a permanent top in oil, a confident top in oil, in order for you to start getting more risk on right now.
All right, well, speaking of that, Teresa, oil is not the only thing that's getting hurt by this effective closure of the Strait of Hormuz. Explain how other commodities are problematic as well.
Absolutely. I mean, obviously, we all see the prices at the pump, and that's really obvious. It's right there. But there's way more than that. So we're seeing effects in everything from corn chips because of the fertilizer shortages to microchips because we also can't get helium through the strait. So there is hope that if somehow magically this resolves near term, the worst of the effects can be blunted. But
it's hard to picture a quick and tidy, end to this fighting. I get the feeling that, investors look at the stock market. We always ask, how's the stock market going to react to this? But the stock market has been calm enough that I think, investors and maybe voters are saying, well, let's wait. They're willing to look past a lot right now. When you see some sort of really adverse reaction in the stock and bond market, I think you might
Which might be starting to happen right now, right? Yeah. It feels like maybe we're at the early part of that moment.
And for the consumer, they've only really felt it in the gas price right now, but when could that change, Teresa?
I mean, really, it's really building. So just a few weeks ago, we were talking about how higher tax refunds were going to fund shopping sprees at the mall. That's looking less and less likely as people have to fill the gap when they fill up their tank. We've seen retail stocks fall, but it's not just them. There's also airlines and cruise companies have also fallen. The fear is people won't have enough to spend on vacation, and they're facing a double whammy because they have higher energy prices as well.
Higher prices, Jack. Let's talk about luxury cars. That used to be a term. Is it now redundant?
Well, maybe. I don't know if you were in the market for a tiny stick shift car called the Nissan Versa. I have bad news. It was canceled in December. It was the last sub $20,000 car in America. Only the stick shift trim level, by the way.
I would pay extra for a stick shift, but not a Versa.
Car makers had been moving up market. They're making more pickup trucks and the sort of higher level SUVs. So affordability was already a conversation. That's before gas prices shot up. So now, last year investors were fine with this. car stocks shot up. This year they're selling off. People have been wondering what's the effect going to be. This past week, car manufacturers started making the rounds and talking to Wall Street about sales trends. It was mostly upbeat. They say that there's still demand out there. It's been supported by higher income buyers, also older buyers. The average age of a new car buyer, around 50 years old. That's up from 43 back in 2000. B of A says it'll probably take 4 to 6 months of higher gasoline prices to change demand trends. Barclays says General Motors looks good here. It's probably going to generate free cash equal to about 15% of its stock market value this year. So farewell Nissan Versa. I couldn't fit one cheek in there, but I respect what they were trying to do out there.
And the average car price now over $50,000.
Yeah, it's
amazing.
expensive.
So when gas prices go up, often that leads to smaller cars, electric cars doing well. I don't think we're there yet. When would that start to happen?
Well, this was the year where it was, the internal combustion engine and the big trucks and everything like that. They were saying ICE is nice for internal combustion engine on Wall Street. So there's a question of whether the mix is right for the moment. But we haven't seen so far, demand pick up for hybrids going forward. There are still, by the way, hybrids and electric vehicles available, but we haven't seen that shift yet.
All righty. Thanks, Jack.